All right, so we were talking about this the other day, Brian and Tom here. I'm behind the camera here. So we were having a discussion about this because I am much more new to the world of dividend investing than you guys, and this came up because it was a legitimate question I had had as I was learning more about this, and I thought we could address it in this video. Specifically, the question was, why in the world would I want to give a company $1,000? We use $1,000 as an example. Why would I want to give them $1,000 to only get $50 or something similar back each year?
And my first response was what? Those $1,000? It's just gone.
That was a response.
It's goodbye. It's gone. Not quite like that, but that was actually what I said. I said when you give somebody an investment money, you give them $1,000, and you need to pretend that money is completely gone, that it doesn't come back because you are giving them a loan and they need a way to pay that back. When you get a mortgage, you get a car loan, you get anything else, they're not just going to come to you tomorrow and say, "Oh yeah, I need that money back." So in this case, I said, $1,000 is gone, and the look on your face is hilarious.
It was funny. It was funny.
Really? It's like, yeah, really. That's what happens. The premise behind that, though, was that as an investment, if you treat it like an investment, you can't. Brian and I have talked about this a lot. It's like you can't just assume that money is going to be there tomorrow, just like it was today, in the same capacity. If you give somebody an investment and that business is going to do something with that, they have to grow their company with that money, which means they're going to be putting that investment into other things that will make them more revenue later on.
And that's what you want. You want them to use that to grow the company. So you don't want to just invest and then get it back the next day because they haven't had time to do anything with it.
Right. If you're that person, you're thinking, well, I'm going to give a company $1,000 and they're going to pay me this dividend. Well, first of all, what is that? The first thing that a dividend really is they're going to pay you the profit sharing. That's a profit sharing bonus on the money that they're making. Now, there's something that you need to keep in mind too. If the company's not making money, what kind of, there's no profit share.
Right.
You're not going to make any money from
They
that.
may have cash on hand where they're still paying the dividend to the cash that they have, but that's not going to last. You want to make sure that the company is going to be healthy enough to eventually make that profit back and weather whatever downfall that they're experiencing.
You know, and I think that was one of the things that was eye-opening about your description of this for me, because I was thinking of it like, like APR or something, like, oh, I'm going to get this percentage back type, like on a loan. But it wasn't that. You're describing it very differently, and it started to make a lot more sense.
Yeah, and we were in a coffee shop, so I used a coffee shop example, and it was, well, here's a mocha, here's a coffee, and if I'm a coffee shop owner, my name is Timmy. Timmy, the coffee shop owner. Timmy! And Timmy wants to grow his business, and he wants to do that. Timmy! He's got to sell product, and the company that you invest in is also selling a product that people need. So in this case, it was coffee. So if I would rather make a penny off of somebody selling 1,000 coffees than make a whole bunch of money off of one product. And when it comes to dividend investing, usually the companies, as compared to growth investing, usually companies that pay dividends, especially the modest ones, not the really exorbitant ones, the ones that say like 5,000% and growth or 300%, or in Zim's case, 30% dividend, there's some red flags with that. They have to have a product that they make money on so that they can pay you back for that loan that you gave them. And the companies that pay dividends usually have a relatively well-established business, and that's what they use to pay you those dividends.
And not only that, they have to have a product that people want.
Yes.
Or need, really.
Yes. So the $1,000, when you buy a dividend-paying stock, the stock market's a really fickle place. So you can have a growth stock that doesn't pay a dividend, and usually if you go back in history, the stock market crashes every 10 years. People don't seem to learn. It's every 10 years, almost like clockwork. Not quite like that some decades, but about every 10 years the market crashes, and when it does, it's like 40% drop. So if you gave this place $1,000 and all of a sudden you don't get a dividend check because they're selling product and you're making profit sharing in that product, there's no dividend, that company drops 40% or $600.
Yeah.
That's scary. So if I was to boil it down to three things, the first thing is this: it's a loan, and it's for a company that has to pay you back that loan.
Okay.
So the second thing I would say is that it's less risky than a growth stock in the form of we get a reward. So if you have a growth stock and the market crashes, it goes down 40%, your $600, that's your total worth. That's all you have left of it. If it's a dividend paying stock, so if you've got a profit sharing on that coffee that this coffee shop is selling, and it's only a penny, at least you know that they will still pay you for
Right.
the fact that you invested in the company. That's what I like about that.
And that's only if you sell, really, right? So if you think of it this way, with a growth stock, it goes down, you lose 40%, you're down 600, you sell it, you've lost 40%. With a dividend, depending on how long you've held it, it goes down 40%. You still lose the $600 or the $400, right?
And then you also get paid.
But you've been paid the dividends throughout all the years that you've held that. So that raises the value, the total value of that stock at sale.
If you get rewarded that way, it's a lot, especially when you get a check in the bank account. In our portfolio, we get somewhere around $40 a month right now. There's a whole story behind that portfolio. Check our other videos out. But that money that comes in every month disincentivizes you to want to sell or even really pay that much attention to the daily gyrations of the market, because the market is a very fickle place sometimes. You can check out all the finances of a business, you can make sure everything's perfect, and it still goes down, especially if I buy it like a week after I buy it. It still drops like 10, 20%. I don't know why. Then it goes back up after that. But so if I buy a stock or we buy a stock, wait a week and then buy it.
And that's the beauty of a dividend stock, because if it does go down, I generally don't care as long as I look at the company's healthy, it's going to be making money. It goes down, the market went down, big deal. They're still paying me the dividend. I'm still getting money. I'm just going to let it ride, keep it going. It's a long-term investment.
We also talked about the long-term aspect of that, the dividends themselves. So everybody's been talking about inflation. We talked about inflation yesterday at the shop. The cost of that coffee used to be like $2 or something. Now it's like $7 for the same coffee. When the place raises their prices rather, their margin goes up most of the time by a little bit more than the increase of the cost of doing business. Therefore, usually the dividend also goes up. And we've got a couple stocks in our portfolio. If you look at Kimberly-Clark as an example, and I showed this to you yesterday, where 20 years ago, Kimberly-Clark was only paying around 28 cents a share. And if that's your original investment, now it's per share. So if you have 10 shares, you make 28 cents on 10 shares. So as time goes on, because the price of, in this case, toilet paper, not coffee, went up, you get a bigger dividend check. Now, if we look at what happened with the stock, ignore the fact that the stock tripled in price. So remember, you have to pretend $1,000 is gone. You can get it back if you absolutely have to have it, but if you pretend the money's gone, and as long as the company's healthy, look what happens to this dividend. I mean, if you go all the way to 2010, it's at 58 cents a share. You go to 2015, it's at 88 cents a share. And now you're at 2020, it's $1.14 per share. So by the time you get to today, it's $1.20 or $1.18 per share on that same thing. So if your dividend yield, so if you get a percentage of their profits, was a 5% profit sharing back then on your original investment, 20 years later, it's more like 30% on that original investment because the dividend check went up.
And that's what they mean when they say dividend growth stock. So there's growth stocks and there's dividend stocks, but the dividends themselves grow over time.
That's one of the things that stood out the most to me about what you were describing was that it's a growth stock. It grows over time because the goal is to have the company grow over time. Right? And then with that, it's kind of like you're sharing in the profits as it grows. And by kind of like, I mean, you are sharing in the profits as it grows.
As profits go up, so do dividends.
And I've seen people, they've argued with us, they've argued with me and says, well, but I can buy a growth stock and I can make that go from $2 a share to 200 like that one guy on the YouTube thing and he made all that money. It's like, yeah, that's 1 out of 10,000 people.
It's possible.
It's possible, but it's not common.
And don't get us wrong, there's nothing inherently bad about growth stock investing. It's tried and true. It works. If you do it right, you can make money almost guaranteed. But it's a little bit more risky than doing a dividend stock method.
To some degree, I understand what they're saying. I mean, if you've got a growth stock and they're not paying a dividend, they're not taking some of those profits and they're not giving them back directly to the people, so that means that they have more money to grow the company. Makes sense. But you have no guarantee that they're going to be able to do that or that there's not going to be some regional conflict that destroys any kind of hope that the market had to begin with, because like I said, the market's a fickle friend that way. Look at our portfolio. I mean, if you look at what we've invested in, it's very utilitarian. Like we buy boring stuff. We buy boring companies, but that's what you want. If you want to have stable, good income that lasts you a long time, my point was this. We buy what? Well, if you look at the portfolio here, toilet paper, wow, that's exciting. Well, I get excited about toilet paper and Campbell's soup and nuts and bolts. Like screws. I mean, but think about when you're buying a company, you want to buy a company that makes products that people have to have. They have to, like, so example, 3M is one of our companies. They make adhesives and paper products, and some of those adhesives go into roofing products. If you don't have a roof over your head, it's kind of a problem, usually.
I kind of take offense to your saying that they're boring. If by boring you mean consistent, then I guess we're boring.
We are. But the point that we're trying to get at is that the companies that we're buying they're boring, but they're consistent, like Brian says, they're predictable, and they're very diversified across a whole broad spectrum of different industries. I mean, we've got Coca-Cola, we've got a bank, we've got a telecom company, we've got toilet paper. That's right. COVID 2.0 comes out, we are prepared.
We're ready.
We're ready.
And the greatest thing about them is they pay a dividend consistently every 4 months, year, whatever their dividend cycle. So you get a dividend every time you get a check. It's yours. You can use it for something. You can reinvest it. If you're in a growth investing type scenario, you have to sell stock in order to get money in order to do things with.
And you pay taxes. Now, somebody could tell me too, like, well, if I get dividends and I don't reinvest them, I'm going to pay taxes. Like, you pay taxes if you reinvest them anyways.
Right.
The difference, though, so the third thing here, and this is more for high income people, you pay capital gains rates on the income that you earn from your investments versus paying regular income, which at the high tax bracket is like 40% almost.
And everybody knows that
That's
the
a
difference between capital gains and actual income is
Tax brackets, if you want to not have the nerd bomb version of like charts and whiteboarding and everything. It's basically that capital gains are taxed at a different bracket. It goes all the way up just like normal income does, but it's taxed at the 15% to begin with. So that's a beautiful thing, because if you invested your money, you've already paid taxes, unless it's like a 401k or a Roth or something, but if you've already paid taxes on that money. When you are at a 15% tax bracket, that's not a big deal. But if you follow this method, this portfolio, and you start investing in over 20 years, your Kimberly-Clark toilet paper stock becomes $1.18 per share, and you bought all those shares 20 years ago and was only paying 20 cents per share, you're going to want to know this because it does pay off. It's not as exciting. And we saw a lot of YouTube channels that they want the exciting stuff.
So allow me to kind of repeat back what I'm hearing from you as some of the biggest reasons dividend stocks are a preferred vehicle for investing. So one, and correct me if I'm wrong on any of these. So one is we consider it in many cases safer because when the stock price fluctuates in a fickle market, you're still going to get paid in most cases. Is that true?
Yep.
Okay.
It's absolutely true.
Okay.
As long as the company is healthy, I'm going
Right.
to make sure they
Stock
Belly.
asterisk.
Yes.
It has to be healthy. You have to check your stocks once in a while to make sure they are still healthy and going to pay and have a profitable methodology to their business.
And you don't do that by going to Reddit. No offense to Reddit. You look at their finances.
Yeah. But yeah, even if the stock price goes down 50%, you don't care as much as long as they're paying their bills. They're still profitable or going to be profitable again in the near future and still paying that dividend check. You're still getting paid.
And this, in large part, is due because it's based on shares, number of shares, not actual stock price. So even if the stock drops, a large percentage, theoretically, the dividend should continue.
You got the same number of shares that you had yesterday before.
Yeah, I like it. The other thing we were talking about briefly was there's a bit less emotion and or gambling feeling behind it because you're looking for a long game, not necessarily a big profit off of a single stock, growth stock.
And that's actually a very good point to make, because what happens to a business's bank account when you pull money out of it when you sell your shares? So if you're selling your stock, somebody else has to buy it. And if there's nobody else to buy it, the company has to pay. So that money comes out of the business. So if you say, I believe in you, I'm going to invest in you, and you come back 2 months later and you're like, oh, well, I want my money back. that's not really investing in the business or the products that they make or the ability for them to provide good services. If they're a services company, you're basically taking that money and gambling it. I mean, you really want to not have that mindset, because look at some of the companies I mean, there's Tesla, Microsoft, there's all the cryptocurrencies out there, all of the very, very talked about stocks. They're crazy volatile, and there's a whole group of people. If you're new to this game, there's a whole group of people that will trade, they'll do options, they'll do puts, they'll do calls, and they're good at it, and they will take your money and they will happily spend it. So when you're buying stocks, time is your friend on this way, especially because of that. And there's a lot of people out there that do that. And I think the census said that out of all those people, 98% of them lost money and 1% break even and 1% actually make money.
Yeah.
And everybody hears about the 1%. Nobody ever thinks they're going to be the 98%. So with this method, you're very unlikely to lose money, because like I said earlier, the $1,000 is gone. It's not really gone. I mean, you can sell your stock and you can get, usually in Kimberly Clark's case, you get thousands of dollars back. But if it didn't do anything, you bought a high dividend paying stock and it went down a little bit, you're still going to get most of your money back. In fact, even if the Kimberly Clark stock over 20 years went to zero, the fact that the dividend paid you that entire time means you made more money in dividend checks than your original investment was worth to begin with. So hopefully that answers your question.
Yeah, heck yeah. And actually, I think one of the next things that's big on this strategy or this approach is diversifying and identifying a large variety of industries and companies to be working with, which is what we'll be talking about in the next video. So we'll see you there.